Welcome to This Explainer. Today, we're diving headfirst into the hidden financial risks and honestly, the staggering volatility behind some of the most hyped future-forward industries out there. We're talking electric vehicles, artificial intelligence, and space exploration. We constantly hear about the massive technological breakthroughs in these fields, but right behind the scenes, there is a highly complex, incredibly high-stakes financial machine at work. Let's start with a bit of a paradox that we really need to unpack. How is it that companies pioneering the brilliant technologies of tomorrow often face such brutal, systemic financial traps today? I mean, you'd think that building the future guarantees a pretty smooth ride, right? But financially speaking, it's often the exact opposite. To really grasp the massive stakes involved here, just look at SpaceX. Following its blockbuster initial public offering, the company's market cap absolutely skyrocketed to a cool $2 trillion, and they raised over $85 billion in the process. Those numbers are literally hard to wrap your head around. But here's the massive takeaway. Whether a company is building literal rockets, engineering the next generation of AI chips, or manufacturing electric vehicles, the journey to become a public market powerhouse is absolutely fraught with systemic risks. These are deeply rooted financial traps that can wipe out even the most innovative startups before they ever get off the ground. Section 1, the Valley of Death. Let's take a look at the early operational risks these companies face right on the factory floor, long before they ever get to ring the bell at the stock exchange. Academic research points to a terrifying phase for EV companies specifically, known as the Valley of Death. Think of it as a treacherous, unforgiving period where a startup burns through its massive initial funding way before it can actually manufacture and sell enough cars to survive. It is a literal race against the clock, and the prize is pure survival. And what's truly staggering here is the sheer financial weight of just a single component. A huge driver of this cash burn is the battery. Battery components can make up to 40% of an entire electric vehicle's cost. Imagine that. When nearly half your entire cost is tied up in one highly volatile component, your early margin predictions are basically crippled from day one. Because of massive costs like that battery, things get complicated incredibly fast. Researchers have mapped this out in a fascinating framework they call the vicious cycle of financial risk. It shows us exactly how these massive, unpredictable costs don't just exist in a vacuum. Instead, they feed into this continuous, nasty loop of systemic uncertainty. Breaking this down, the cycle is built on four interacting pillars. You have inconsistent government policies and a lack of charging infrastructure, which instantly ramps up a company's capital intensity. Basically, they have to spend way more money upfront just to exist. That massive cost creates consumer hesitation, which leads to demand uncertainty. And guess what happens when demand is unpredictable? It becomes literally impossible to secure stable supply chains. It's a negative loop that actively strangles investment. Moving on to Section 2, Supply Chains and the Scale Conundrum. Let's look at how this cycle builds into an absolute operational nightmare on the manufacturing side. EV startups find themselves trapped in what researchers call the scale conundrum. Think about it like this. They desperately need massive manufacturing facilities to achieve economies of scale and lower their costs. But they can't justify spending that kind of massive capital without a credible forecast of consumer demand. Yet, they can't secure that demand unless their costs, and therefore their sticker prices, are already low. They are totally stuck in a loop. Throw highly volatile supply chains into the mix and the problem just multiplies. These startups are dealing with critical mineral shortages for essential stuff like lithium, cobalt, and nickel, not to mention recurring semiconductor scarcity. Because they can't predict their demand, they can't commit to long-term supplier contracts. So a startup's carefully planned, beautiful budget can literally be destroyed overnight by one unpredictable bottleneck. As the research so elegantly points out, the real threat to building the future isn't just one specific technological hurdle. No, it's this interactively reinforcing system of financial risk. It's like a giant game of whack-a-mole. You fix one problem, and three more immediately adapt to take its place. Which brings us to Section 3, the public market crucible. Now, let's say a capital-intensive company actually survives this valley of death, navigates all those supply chain nightmares, and manages to go public. Time to pop the champagne, right? Well, unfortunately, a whole new nightmare is just beginning in the public markets. Take the AI chipmaker Cerebras, for example. Right after their own blockbuster IPO, they absolutely crushed their first quarter. They posted over $193 million in revenue, up a whopping 94%. And they announced a massive $20 billion deal to provide computing capacity to OpenAI. And yet, their stock inexplicably plunged 18%. And to be clear, this wasn't a case of a company failing to deliver on its promises. The fundamentals were objectively stellar. They beat Wall Street estimates across the board, they edged incredibly close to actual profitability, and their unique wafer-scale engine technology is literally touted by management as the fastest AI chip in the entire world. They delivered absolutely everything investors wanted, and then some. So, why the severe punishment? Well, as financial analysts point out, in the wake of a highly hyped IPO, investor expectations can become completely detached from reality. The expectations get so astronomically high that even objectively incredible expectation-beating results simply aren't good enough to satisfy the market's initial frenzy. Section 4. The Valuation Trap. This incredibly harsh reality brings us right back to the biggest player of them all, SpaceX, which is currently hurtling toward its own impending public reckoning. Right now, SpaceX is trading at an exorbitant 110 times its sales and 54 times next year's expected sales. That kind of valuation magnitude is practically guaranteed to amplify the stock's volatility. It's priced not just for perfection, it is priced for absolute, undisputed dominance. And what's really fascinating here is the incredibly tight timeline they're operating on. Their historic IPO was in early July. Their first highly anticipated quarterly earnings report hits in late July or early August. And just 2 days after those results drop, a staggered lockup expiration hits. This allows employees and early insiders to legally sell 20% of their shares, meaning a massive flood of new shares could suddenly hit the open market. And here's the craziest structural trap. Ironically, if the company crushes its earnings and the stock performs incredibly well, say trading 30% above its IPO price at $175, it automatically triggers the release of an additional 10% of insider shares. So massive success could literally flood the market with sellable stock, ultimately pushing the price right back down. Section 5. Lessons for investors. So what exactly connects a struggling electric vehicle startup fighting for lithium to a massive AI giant navigating post-IPO lockups? The main takeaway we need to grasp is that building the future requires a completely new financial playbook. Whether you're an EV startup budgeting for fluctuating cobalt prices or a massive AI firm forecasting post-IPO revenue, static financial planning is totally dead. Massive capital intensity breeds extreme volatility, for sure. Companies have to build dynamic, multi-layered forecasting models. And as investors, we need to realize that public market valuations can entirely detach from fundamental business reality. Which leads us to a pretty highly anticipated scenario to watch for. Will SpaceX fall victim to the exact same unrealistic expectations and complex lockup mechanics that just severely punish Cerebras? As we've seen, the fundamentals can be absolutely perfect while the market reaction is still downright brutal. Ultimately, looking at all these incredibly hyped sectors, from the early stage valley of death in EVs to the wild valuation traps of AI and space, we have to ask ourselves, knowing the vicious cycles of financial risk that govern these industries, just how much volatility are you truly willing to stomach to help fund the future?